Welcome back to our private debt forum. We will now move on to our next panel to talk about evolving investment strategies and the global opportunities. Let me very briefly introduce the speakers. We have the pleasure to have a great roundtable. Apparently, on this side, they are the cool guys, and on the other side, the well-dressed guys. So the competition is open. Let me briefly introduce them to you. On my right-hand side, we have Rupert Gill from BlackRock. We also have Richard Cherry from M&G Investments. On my left side, we have Wim Vermeer, Chief Investment Officer. Actually, I will make it brief, and you will, of course, give some more details from AG Insurance and AGEAS, and also Alexandre Brogy from HSBS AM, and we have two great moderators on both sides. We have Emmanuel Gillet-Lagarde, Head of Real Estate, Real Assets and Global Trade APAC, and also Karim Medzani, Global Head of Syndicate and Loan Distribution. Well, the floor is yours to introduce the panel and then a little bit more about our speakers. Thank you.
Thank you, Christina. Welcome to the Global Investor Panel. We have gathered a diverse group of investors today to discuss a few thematics on private debt and get them to share their perspective. In first place, we already saw that this morning. Private debt has a quite broad definition. And then what does private debt mean for them? Do they see geographical or product opportunities? And what are the keys to be successful in such strategies? And finally, two hot topics that were already, I would say, approached this morning. Is there any impact of the current public market environment, in particular pricing, on their private debt investment strategies? And what is the impact of ESG considerations in the context of private debt?
Thank you, Emmanuel. Good morning, good afternoon to all of you. I'm very pleased to welcome on stage our four panelists. So we'll just introduce them briefly and say a few words about them. So next to Emmanuel, in the cool guy table, you have Alexandre Brogy. So Alexandre, you are Senior Portfolio Manager in Infrastructure Debt Investment at HSBC IM. You are based in Hong Kong, so you will be able to give us or to share your view on Asia Pacific region also. Next to Alexandre, we've got Wim Vermeer. You are Chief Investment Officer at AG Insurance and AGEAS, and you will give us the view of multi-asset investors. Sitting on my left, we have Richard Cherry. You are Director, Private Credit in M&G Investment. And next to Richard, we've got Rupert Gill. You are Director, Head of European Real Estate Debt at BlackRock. So guys, my first set of questions to all of you, and we will start with you if that's okay, is how do you define private debt? What does it represent for your organization? And maybe a bonus question, how has it evolved over the past years?
Okay, that's a very interesting question. I think private debt is for us a very broad range. Actually, for an insurance company, we were until 10 years ago, 15 years ago, only investing in equities, corporate bonds and government bonds. We know what happened with the yield, so we were searching for alternatives. And that's why we have discovered this private debt class. And it starts already with government related, so at a very low risk end. It goes into social housing, as it was discussed this morning. Very interesting. If you really look for very long maturities, it's a really interesting asset class. It's about mortgages, residential mortgages. Interesting because you have it at a very low capital charge, almost zero even. If you then can invest at a 2% at a zero capital charge. That's much better than the 0% you had on government bonds, Dutch government bonds with the same tenor, I would say. And then the most known asset class is infrastructure. We started 10 years ago, I think, together. I think we were one of the first clients.
You were definitely the first.
I think
you were one of the pioneers.
Yeah,
we
have an anniversary actually, more or less, I think, now, because it's now 10 years. Because there again, we were looking for alternatives for our long maturities. And now we have something like 3 billion there. So it has been a successful activity there. And it goes into corporate loans and direct lending, where you really, I would say, in the more risky part. What's for us the most important part is that we have this choice, that we can do the matching. That it's illiquid for us is not a problem, because we also have very illiquid liabilities. So if we can do the matching, there's no issue there. There is no penalty for illiquidity as well in the capital charge for insurance. So it's a perfect asset class there. I think what is changing now, the big change now is that we are not anymore in the zero interest rate environment, that we see that there are also liquid alternatives. Governments bonds at zero, at that 0.5% was a no-go. If you now see that that we can buy Belgian or French government bonds above 2%, that's really a change. But I think in general, our approach has always been very opportunistic. We have no specific targets for specific private debt asset class. We have a kind of strategic asset allocation, but tactically we do always something else, because the opportunities in the markets are different. Sometimes there is, I would say, supply, and then in other asset class there is nothing. So we have really kept this very, I would say, opportunistic allocation within the private asset class. And now again, even the allocation between liquid public market and private markets is also something where we are very, I would say, agnostic and opportunistic in.
Thank you very much, Wim. Richard, do you want to carry on and tell us more in the M&G context?
Sure, thank you very much. Good morning, everyone. I manage a team at M&G that invests in what we call multi-asset private credit portfolios. So what this means is we invest in private debt, I guess, across the spectrum. So we have a very wide investment universe, and we invest in all the different areas of private debt where M&G is active. We think that's very important to ensure that we can, I guess, deliver the best value for our investors. So dynamics in individual markets always change. Certain sub-markets become cheaper or more expensive at different times. So having a very wide investment mandate gives us the opportunity to really invest where the value is for our clients. So I guess some of the areas where we invest is of course on the corporate side, direct lending and the leveraged loan market, but also private infrastructure debt, private real estate debt. We're quite active in public and private ABS. So we do quite a lot in terms of private ABS transactions, also asset-based lending transactions, and also invest directly in mortgage pools or consumer loan pools as well, which we buy from banks. I've probably left out a few other markets. Private placement markets is another one where we're active for my team's funds. Quite active in social housing as well. So it's really quite a broad remit for us, and it's also broad across geographies. You know, in the UK, in Europe, in the US, in Asia and Australasia. So they're all markets where we have people you know, actively sourcing private debt transactions for our portfolios. Now, I guess in terms of you know, what we're seeing in the current market and what's changed more recently is I guess we're always comparing the value in private debt to what we get for our investors in public debt. And you know, I think you do have to look a little bit harder for those returns in private debt markets right now. But again, this is where breadth really helps. If you have such a wide opportunity set, there are opportunities out there to find and continue investing for our clients.
Thank you. We will be talking about opportunities in a few minutes. Rupert, if you can give us your view at BlackRock, but also as a real estate debt specialist.
Yeah, sure. Good morning, everyone. So I'll focus on real estate debt. BlackRock has been investing in commercial real estate debt for more than 20 years. And the market, if you go back 15 years or so, the market was traditionally mezz investment market. I think Niels talked about that earlier. So the market has changed significantly over the last 5 years, particularly in Europe, where there is much more investment in senior loans, whole loans, as well as mezz. But I think in our market, in real estate debt, it's actually quite difficult to find a sort of public market equivalent. Certainly in Europe, you know, the CMBS market doesn't particularly make up a large proportion of real estate debt lending. It's important to some borrowers, but it's not a significant portion of the market. There's corporate REITs, you issue bonds, but in reality, it's difficult to find a read across into the public markets. So our view is that we can offer, you know, investors, our clients, access to a product that isn't readily available in these public markets. You know, we're offering investors real estate risk, but with some downside protection, whether you're in a senior loan, whether you're in a mezz loan, there is usually a significant amount of equity behind you. And obviously it's asset-backed. Real estate debt does have bond attributes, and that's what we're always looking for in our, you know, sort of private debt investments. There are bond attributes. You will typically have stable cash flows, predictable cash flows, hopefully, depending on inflation and interest rates. But what we particularly like about private debt is that we're able to underwrite specific situations. So we're not relying on an issuer, and we're not relying on a particular originator to structure a deal or to put together a particular capital stack. We can do that ourselves. Often we will negotiate one-to-one with the sponsor, and we can pick and choose which deals we want to do. So there's much more, we think, control as to what we are buying or what we are, you know, originating. You know, these loans, certainly in Europe, are typically floating rate, so they do offer a certain degree of protection against interest rate movements. And then lending against real estate, theoretically, and Patrick talked about it earlier, but theoretically with real estate, there is some inbuilt protection against inflation as well, although I doubt it will ever be perfectly correlated. I think the challenge for some investors we found with real estate debt is where does real estate debt sit within their books? Is it real estate or is it fixed income? And that has been a challenge for some, particularly insurance companies. I think maybe now everyone has reached a conclusion, but that has always been a bit of a challenge. What has changed? I mean, Europe has been in real estate debt has certainly been behind the US. Private debt in the US has been a much more significant component of the lending market than in Europe. Europe has been dominated by banks for many, many years, and what we have seen through the changes in banking regulations, then there has been much more of an opportunity for private debt to come in and make a difference. And I think particularly over the last few months, that has become more apparent when private debt investors perhaps are offering a little bit more certainty of execution than perhaps some of their banking peers.
Great. Thank you, Rupert. Alex, if you want to conclude on that first question, please.
Thanks. Good morning, everyone. So I work in the infra-debt team of HSBC Asset Management. So we invest in infrastructure, so energy, transportation, social infrastructure, telecom, on a global basis for our clients, typically life insurance clients. So you may be aware, infrastructure offers long duration. It offers fairly a good capital treatment, especially under Solvency II or similar regulations for insurers. So we basically build books with a very long duration, so I'm talking 15 or more years, at a favorable capital treatment, and we also benefit from a bit of illiquidity premium and complexity premium. Some of our transactions are fairly complex. So it for a risk that is to some extent a proxy to the relevant government, because infrastructure is a heavily regulated sector, we're able to deliver an additional yield compared to these the equivalent government bonds, etc. We are a small team of about 16 people, most of them in the UK. We have a small team in Hong Kong, where I sit, to cover a bit more the Asia-Pacific region. The rest of the team is covered out of the UK. We have about $2.5 billion of asset under management. Most of what we've done historically has been in the fixed rate space, again, for duration benefit. So you're also getting the duration, the matching adjustment and the Solvency II. But more recently, last year we launched a high yield fund to spice things up a bit. Again, you get the favorable capital treatment compared to the similarly rated asset. And we also recently launched a floating rate fund, again, partly to deal with the changing interest rate environment. And we work with banks, including Natixis, to show us transaction. Again, we are a very small team. We try to cover the whole world, but yeah, we rely heavily on banks to arrange and structure transactions for us. We spend a bit more time on structuring on the high yield space, but in the investment grade space, we rely on banks to do that for us. We can't do everything ourselves.
Thank you, Alex. So let's move now to the second thematic on geographical and product opportunities. So maybe to kick off, Rupert, what do you at BlackRock see as geographical opportunities, and what is required in your view to be successful in these markets?
So as head of Europe, and I'll talk up the European opportunities, obviously. But yeah, so as I said just now, at BlackRock, we have a global business, and we invest in both the US from a real estate debt perspective, as well as Europe. And there's clearly similarities between the two, and there's also differences. In the US, it's a much more mature market, as I said just now, and it's a much more, I think, capital markets focused. And there's a lot more, and there has been a lot more private debt growth in the US, and private debt has a much bigger influence on lending practices than over here in Europe, which is much more bank dominated. The US market then is, I think, much more liquid. That means, though, when there are problems in the market, the private debt market reacts much quicker, certainly credit spread-wise, lending practice-wise, to market volatility than perhaps it does in Europe. So from a European perspective, the growth of private debt has been much slower. As I said just now, I think that is changing and has changed over the last 5 years as banking regulation in Europe is starting to bite. And I think over the last few months, and probably last few years, because of the pandemic, we've seen much more opportunity for real estate debt, private debt funds in Europe. It is dominated by banks, but I think that is changing. I do think that is the opportunity. The US is more mature, it's much more liquid, it's perhaps easier to originate deals, to source deals. Perhaps my colleagues in the US might disagree, but I think it is generally an easier market to come across transactions. Over here in Europe, it's a lot more difficult, and so we have to work with banks like Natixis to help us source those transactions, but it is a lot more difficult to find those types of deals. Each country in Europe is different. That's obvious. Maybe one currency, but very, very different. The security laws are very different across Europe. Getting capital into those countries is different from one country to another. So getting capital in is difficult. Getting capital out is difficult. The property markets themselves are very different as well. So from our perspective, to be successful, you really need to have either local expertise, local representation, or a thorough knowledge of those markets. The way we set our business up is that we have property investment teams that are either based locally or they are investing in those particular countries. And I think that is essential, particularly now, right? Not just now, over the last 3 years, having the insight into those local markets, if things go wrong, I think is absolutely crucial. So, we don't always get it right. It's not always perfect, but that's the way we try and set up our business. So I'll stop there.
Thank you, Rupert. Richard, similar question to you. So noting the breadth of products, sectors and jurisdictions within your M&G mandates, where do you see value in the private debt markets, and where what is required to be successful deploying capital in these markets?
Yes, I guess even though we cover a broad range of markets in terms of sector and geography, we're very much bottom-up investors. So we look at each investment on its own merits and to make the decision on whether to include in portfolios. So we are still looking across that broad range of sectors and markets for opportunities, and still finding them in across the board. But having said that, I guess in recent months things have been changing, obviously, and I guess what you tend to see during these periods of public market widening and volatility is the private markets tend to react with a lag, and that lag can be different for different pockets of the market. So a lot of what we do is I guess the equivalent of new issuance. It's new deals that we arrange with private debt borrowers. There might be bilateral transactions where it's just M&G as the only lender. It might be a small club deal. It might be a transaction in partnership with a bank. But this is all akin to new issuance. And in the same way that you've seen a slowdown in new issuance in public markets, you're seeing that in private markets. And a lot of that, I guess, is just driven by price. Borrowers have been used to paying a certain yield for some time, and are really waiting to see what happens with the current volatility, and that puts a bit of a pause on the market. Now trades are still happening. Certain borrowers need the money or are willing to pay these levels. So having that breadth really helps us capture those opportunities right now. But borrowers can't sit on their hands forever. So if the current market dynamics persist and we're on a prolonged period of higher yields, then at some point that issuance comes back and it reprices to still offer that illiquidity and complexity premium above public markets. And for a while, the market probably plays catch up, and you see a lot of issuance. So I think we're kind of in that transition period at the moment. We're starting to see various parts of the private debt market come back, start to reprice, but it's really the start, and it really differs in different regions and different sectors. So I think if the repricing in public markets persists, then we'll see that in private markets as well. But just in the meantime, it's more of picking the opportunities which are priced appropriately right now, and being a little bit more patient until private markets reprice. Now, but to give a little bit of a flavour on what we have been seeing, I think Asia is a region where we've been seeing more transactions lately, and that includes Australasia for us, which are pricing more attractive levels, and we've been quite active in transactions, which I guess I'd classify as private ABS, and you know that's been a theme for us for a while. The usual trade was I guess like warehouse financing, so we would finance a fintech until they reach the appropriate size for a public market issuance. But what's interesting, what we're seeing at the moment is I guess. The next bracket up, the larger issuers are coming to the private market. Issuers who historically might have gone to the public market are going private or semi-private just for certainty of execution. So we are seeing some opportunities there in terms of private or semi-private ABS right now as well.
Maybe I just add, I think, in terms of where is value, I would say maybe a little bit glibly, but the value is in private debt. And certainly what we're starting to see is a gap starting to appear between not so much the public markets. As I said, there's not much of a public market read-through in real estate lending, but it's more between perhaps where the banks will lend and where the borrower's expectations are. Now, some of that will get filtered out through, asset price movements, and certainly we're hearing about a bid-offer spread that's going on at the moment, price chipping on real estate transactions. But I do think the opportunity in our market is for private debt to fill the gap, whether it's writing whole loans, whether it's writing senior loans where banks don't really want to lend to anymore, or whether it's writing mezz loans just to fill that gap between equity and senior debt.
Yeah, and sorry, just one more point on what I think you need to be successful in this market is I think you do need that breadth of coverage to see all the opportunities, to pick the right ones for your investors. But if you're going to have that breadth, you can't do that lightly. It's a lot of resource, it's a lot of people. You need to have expertise in each market where you operate, and that's more than just geography, that's sector. There's nuances to various sectors in private debt. So you need to have sector and geographic expertise in every area where you're active. You need to have legal expertise, structuring expertise. So it's a lot of resource to invest in, but if you don't invest in that, then you really can't properly understand and structure the opportunities. And if you don't do that broadly across a range of markets, you're not going to see enough opportunities. So I think a significant and appropriate resource is one of the key things that you need in this market.
Thank you, Richard. And maybe to finish on this topic, Alex, I guess you're much more focused in terms of product, but with your APAC lenses, if you can, where do you see, geographical opportunity from your perspective?
Yeah, so I mean, the team invests globally. We get most of our funding in US dollars. So it might be a bit different from some of you in the room. We have a lot of euro, so we spend less time in the European market currently. But comparatively, we spend a lot of time in the US, we're in Australia, Latin America, Middle East. Asia is a tricky one, actually. So even though I'm based in Hong Kong, I spend most of my time on non-Asian transaction. In our specific market, the banks still tend to do most of the deal in the Asian market, whether it's the international banks or the local banks. So we do a lot in Australia. Our key markets are the US still. It's very liquid, very diversified market. The US private placement in particular, where we spend most of our time. The second market would be Australia, which in the Asia-Pacific market is by far the largest. Again, well-structured transaction, highly rated counterparties usually, so it's a sort of an easy one. Again, not the best priced, but that's where we spend a lot of time. Then, funnily enough, we got Chile. Again, if you look at the US dollar market with good yield, good credits, it's an OECD market. It's our third largest market by size of investment. We spend a bit of time in the Middle East. Middle East coming back with all the energy discussion, so it's going back at the center of energy supply. We have done a few interesting transactions in Asia, but they tend to be few and far between, so there's not that much spread. So not much diversity. We have a fairly strong focus on emerging market, being HSBC. So you have LATAM and you have Asia. We have plans on deploying more in that market. We do local currency transaction with some of our clients have given us local currency in the Asian market. So that's where we can play. We can play with the banks. We're finalizing a transaction in the Philippines, for instance, which is not an obvious market, but we find, again, quality credits with all the ticks you would expect from an infrastructure asset globally. But we would expect going forward to continue have probably a majority or a large minority of our asset in the US. And then Australia, and well, so we got Chile in Latin America. We're also doing a few other, covering a few other markets there. We need to check the political situation and otherwise. But again, we built for diversification, geographically speaking.
Thank you very much, Alex. Our third question is linked to markets evolution. We touched base that a bit earlier with Niels and Patrick. I think Patrick said that we are going through a very important change in the market. We do have rates going higher. Some may think that it will stop. Some may think that it will continue. We are starting to see spreads going wider. This is clearly the case in public market if we are looking at investment grade and high yield debt. The question for you is, what has been the impact on your private debt investment strategy in the current market context and public market repricing? What does it require to keep on being successful in this new environment? Alex, would you like to kick off with that one?
Yeah, so there's really two things. I would put the macroeconomic, geopolitical, political factor in one bucket, and then we can talk about the pricing situation. So the first bucket, I mean, we tend to plan for a lot of things. We don't have control. We are debt investors, so we have very little control directly over our direct counterparts. But we plan for a lot of things. And we also focus on infrastructure, which is essential assets. So nobody planned for COVID. We didn't plan for COVID, obviously. But so I would say 1 year later, we had very few difficult credit in our portfolio. We even have airports in our portfolio. They didn't fare that bad. I mean, if you have a monopoly airport, which is the entry point for the country, you know the government is going to step in. So we didn't experience a default situation or anything like that because we focus on essential assets. We had toll roads in Australia where lockdowns kept everybody at home. 6 months later, traffic was back to normal. It's now back above the pre-COVID level. We have the whole energy supply chain, which is a favorite for the investors again. So all of that, we planned for that. Talking about inflation, infrastructure assets tend to have a built-in inflation protection from a credit point of view. Either the revenues will be inflation indexed or similarly indexed, or the cost base is very low. So inflation is not so much of a concern for us directly. We got geopolitical and political consideration, but that's where we built the, sector diversification and geographical diversification. We'll never put too much. We have country caps, typically, where we know we cannot put too much. And it's applicable to all markets, whether it's the US or Chile or France. So we would have limits on that. So we deal with that by, again, building that geographical diversification. And again, we invest across the cycle. So we had a chance of doing some very good deals at the very beginning of COVID, where other markets were closed. So we did a few good investments. Now the pricing has moved against us, so we suffer from that private market discount compared to the public market. It's a tricky one. Now, that's where we have more conversation with our investors. So the spreads are still quite constrained on the private market for us compared to what you can see in the limited public infrastructure debt market. But we look at overall yield as well. Again, we invest for the next 20 or 30 years. So we're able to get significant and better yields than we were 6 months ago or a year ago. So we also look at that as well. The spread right now is not fantastic, but if you invest across the cycle and you're able to lock in good yields, and you know you're going to get that return for the next 20 or 30 years, it's usually not such a bad deal. And for people who are quite concerned about the current level of rates in the private markets, that's where our floating rate strategy can offer a bit that protection as well.
Thank you, Alex. Wim, can you give us your view as a multi-asset investors, and also what is required to be successful or competitive in this environment?
Indeed, I think it is pretty difficult situation now. And I think you said it this morning, we are a little bit waiting. It's similar what we are doing. We're a little bit waiting for the price setting to be to take place. And it's certainly, I have the impression that in certain clients, certain projects haven't seen the recent interest rate movement. We had recently said no to a very nice solar project in Italy, because if you compared the yields with what you could have in Italian government bonds, it was completely great. It was below. Well, that doesn't make any sense. Nevertheless, the project has been placed and financed without any problem. So normally you congratulate the team when they do a deal. So here I sent an email to congratulate them that we haven't done the deal. Because sometimes I think now you have to be prudent and a little bit more selective than what we used to do until 1 year ago. And then in general, I think what is the success in this market? You have to understand in private markets in general. I think we have to understand it's a different market from what we normally do. Huh? So it's not only buying your corporate bond or your equity on Bloomberg. So we have hired a specialist in certain domains. We have an infrastructure team of 5 people now, fully dedicated to that. We have one person who is specialist in Dutch mortgages. If you want to know the prices of the houses in Bergen-op-Zoom or in Groningen, she knows everything about it. But okay, we also have there a 3 billion portfolio. So it's something you need to follow and to have some specialists there, so that they also can, let's say, speak with all the providers that are coming with nice deals. So I think that's important, the people. I think the processes need to be different. As you said, investing for a long time and you're buying to hold, you really need more strict due diligence, more governance, more documented than in more liquid markets where you can step in and step out. ESG analysis is becoming also very important in that sense. So I would say processes, people, processes, and the last P is partnerships. I think it's very important that you're not going for one transaction, but for let's say a collaboration, a cooperation in a lot of transactions. And what there is important for me as well is that there's some skin in the game. So you are calling it originate to distribute. You should call it originate to co-invest, I think. Because that's also very important. I think that you know that your partner is also taking part of the risk.
Thank you. So person or people, process, and partnership. So we have a new definition of PPP. Okay, thank you. Rupert, your mandate is private debt only. Having said that, can you tell us what is the impact of the dislocation between public and private market in your investment strategy?
Yeah, sure. I mean, as I said just now, there isn't an easy public markets, capital markets, read across for real estate debt in Europe. Having said that, we have picked up some paper that was, destined for capital markets issuance, and we're able to pick some of that paper up at wider margins than 6 months ago. But I think there's many different factors kind of at play here. If you're a floating rate investor or floating rate lender, you are naturally right now picking up return increases, right? So without any kind of changes in credit spreads, without any kind of changes in your view of credit or risk, you are naturally picking up an increase in return. So for many debt funds in our space, they are return focused. They promise a certain return to their investors, to their LPs and the funds, and now you're exceeding expectations, although to be fair, for the last couple of years, I think returns have been under huge pressure just because of the weight of capital and pressure to deploy after kind of a lack of deployment during COVID. So maybe now we're just earning something back that should have earned over the last few years. But there is just a natural pickup now for many funds. And so what we are perhaps perversely seeing is actually pressure on credit spreads in some parts of the market. And that is from sheer weight of capital. Like I said earlier, there's been a lot of capital now being raised in European private debt, and that is putting pressure on spreads. It's going to be interesting to see how the property market in Europe reacts. We are hearing about price chipping. We're hearing about bid-offer spreads that is kind of slowing down the market to a certain degree. But there's so much capital that has been raised to deploy into real estate in Europe, across the world. We'll see how that pricing reacts. We'll see how pricing reacts, in the private debt markets for real estate. We're hearing about banks who are raising margins 10 basis points. That doesn't feel like much of a reaction to what we've seen in the capital markets. But I think eventually credit spreads, in our markets probably will catch up. Back 15 years ago, we were writing mezz in Europe and the US at LIBOR plus 200 over. So that was our credit spread 15 years ago. Now we are earning 600, 700, sometimes 800 over. So are we going to go back to a situation where a mezz credit spread is 200 over, which is kind of where banks are lending today? I'm not sure we will. I don't think we will. I think the risk, or the perceived risk, in our market is very different to what it was 15 years ago. 15 years ago was a boom time, and debt was freely available, and peak consumption, maybe it's peak consumption in 2019, but it's a very, very different economic environment. So I'm not convinced we will go back to a 200 over, 300 over mezz spread environment. At least I hope not anyway.
Thank you.
So to finish the last topic, and it was largely discussed on the previous panel, is ESG. So Richard, in the context of the M&G's impact financing, how do ESG consideration impact your investment strategy and approach on some aspects, resources, expertise, data?
Sure. I guess just a few words to begin with on ESG in general in private debt, and I'll probably be reiterating some themes from this morning. When you're looking at ESG in private debt, I think by far the biggest issue, as again was mentioned this morning, is data. So on one level, it is data from your borrowers to allow you to do the proper ESG analysis or ESG reporting. But it's also, I guess, a lack of coverage and data from third-party providers as well. So if you're managing a fund in public markets which has restrictions on various product involvement types, alcohol, tobacco, weapons, you want to exclude UNGC, red or yellow flags, you want to target companies with high ESG scores. It's very easy to do in public markets. You can buy in the data from MSCI, Sustainalytics, and the job's done for you. You really don't have any of that on private side. There's a smattering of coverage from those type of companies, maybe in the lev loan market, but that's about it. So if you're going to try to run those type of strategies on private side, you need to do the work yourself. You need to do your own product involvement assessments, UNGC assessments, your own ESG scoring of the private companies, because no one's going to do it for you. So again, that's another area in private debt which needs a lot of resource if that's what you're going to attempt. Now, I think one of the positives in terms of private debt and ESG is an ability to engage, this just private side in general, you have a much closer relationship with management and a much stronger ability to engage. But when you're looking at transactions which are, say, bilateral or small club deals where you're the only lender or one of a very small group of lenders, then you have a much stronger hand in engagement than you do in, say, public markets. So it's part that closer relationship, but also part that I guess a stronger power to engage that you often get in private debt. So you can talk to the company and try to extract the ESG information and data that you need. Now, you have to be a little bit pragmatic about that. Smaller companies may not have the resources to produce the reams of ESG information that you're used to on the public side. So you've got to be a bit more focused and think, okay, what's really important for this company and this company's business, and engage to get that information. Don't worry about filling out a 3-page questionnaire of that you're sending to every company. You have to be much more tailored in your engagement and get what really matters. Now, another strategy that's managed by my team, as was mentioned, is a strategy we call the impact financing strategy, and what that is I guess it's impact investment strategies in private debt, and we think private debt is a really good area for impact investment for a number of reasons, but I guess one of them is the availability and I guess ease in identifying impact assets in this sector. Now the reason for that is a lot of the lending that we do is to finance specific discrete projects. So we'll be financing the construction of a new wind farm, of new social housing, of a new hospital, of new university facilities, of a new green building. So when you're financing specific assets, it's very easy to point to the environmental or social impact of those assets. And if we're doing corporate lending in private debt space, you're normally lending to smaller companies, and smaller companies are much more likely to be pure play companies. So if you can find a company in an impact sector, again, most of the company's business is much more likely to be impact. If you're trying to corporate impact investing in public markets, I guess the issue you have is too many large public companies are involved in too many areas. So 5% of their business might be highly impactful, but the rest isn't. So in private markets, by targeting smaller companies, there's a lot more pure play investments that are available, as well as the discrete projects with clear positive impact that we find in this market.
Thank you, Richard. Wim, same question for you.
Yeah, I agree. In one sense, it's more complicated in private markets than in public market, the ESG part, and in another sense, it's much easier. I think it's more complicated because of the lack of data. I'm still surprised when I receive all these reports of the technical advisors that the part about ESG and impact on society and on the environment it remains very small. There's a little bit about Equator principles, but that's very general. I think that's certainly something that should improve. I think if you look in certain deals, we see it in real estate, for instance. There you see already a lot about eco efficiency and energy efficiency. That's what I mean. Energy efficiency of the building and so on. So that's already part of the normal, I would say, analysis. You cannot say it's ESG data. It's data about the building. I think in infrastructure, for instance, we should go further in that, and also all the advisors should also give that type of information, because we as a client, we are asking for that. So in that sense, it's more complicated. Even if you know, in public markets, even if you buy the data, it's not always high quality either, so do not exaggerate that part either. On the other side, it's easy, I think, talking about sustainability in this type of projects, because you have specific projects. If you're really investing in a state-of-the-art, energy-efficient building, you can really talk about that and show it. In infrastructure, we do a lot in green energy, renewables. We have invested more or less 1 billion billion there on the last 5 years. That makes an impact. Social housing is certainly also something where you can really, let's say, show the positive impact. On top of it, if you look at how they are now renewing all these new affordable housing or social housing, it's also a lot of work for the Green Deal as well, about isolation and so on. So it works on both levels, on the social part and on the green part. But I'm also thinking about a lot of, let's say, infrastructure now is about fiber to the home. That's also, I think, has a positive sustainable impact because it helps people to work from home, to have less, let's say, transport. I think that's positive as well. And I think it's also a very strong message to our clients. So our balance sheet is 75 billion. In Belgium, 35 billion more or less is linked to pension products. So it's really long maturities. You can invest a lot of that in this type of infrastructure and social housing projects. And that is also a strong message to our clients that we say, okay, we use your pension money and we invest it long term to have a positive impact on your return, but also have a positive impact on society and on environment. So I think indeed there the ESG is for me very clear and very strategic.
Thank you, Wim. And maybe to close this panel, Alex, what does ESG mean in the context of your infrastructure financing?
Yeah, thanks. So the previous speakers have already mentioned quite a few things which are very relevant to us. Infrastructure touches about 70 or 80% of carbon emissions in the global economy. That's the whole energy sector, which is the biggest part, obviously. You go transport, which is a big chunk as well. And then you look at all the cement and steel which are embedded in this infrastructure, and you get to that level. So it's a very large component. So it always was a part of our analysis, a credit analysis. It continues to be so. We have more methodology, more advanced methodology. We struggle a bit sometimes to get the information from our borrowers or issuers, but increasingly they know they're having to provide that. The banks are asking for it. Slowly, the investors are starting to insist on getting it as well. So it's improving. We find some industries, like the fossil fuel industry, actually tends to be very good at providing a very detailed analysis, which in terms of meeting regulatory requirements is actually very good. It's not as good in other aspects. But that's moving. Some other, you would say, greener industries, actually they are less used on providing the sort of information which are needed because they say, well, my project is green anyway. Why should I spend the time and the resources on ticking all your boxes? But the regulatory front is there as well. So more is coming from that front. We are moving some of our funds to Article 8 as well. So that creates additional requirements. But the demand from our investors, whenever we raise funds, we spend a lot of time on explaining our methodologies, our internal procedures, what we will do and what we will not do. So we spend a lot of time on explaining the deals we have declined and why we've declined them. So it's that. So there's that, I would say, credit analysis, which is very important. We face risk of stranded assets. So we obviously still have to invest in less green forms of energy. The global economy, unfortunately, cannot do without right now. So we're still having to deal with natural gas and others. We don't do coal, but we still have to do natural gas, especially when we deal with emerging markets. So it becomes the social part of the ESG as well. We have to balance things as well. But we face the risk of stranded assets. So if we invest in a new natural gas field right now, we face the risk that in 10 years' time, there won't be any buyer for that gas. So we have to deal with that as well. And we face another risk, which is unfortunate, but that's the very reality. And we see that on individual projects, is we see the impact of climate change on our projects. So we recently invested in some very nice renewable assets. Unfortunately, those assets were located in parts of the world which has faced the worst forest fires in recent years as well. So we're facing flood risk, typhoons, etc. So it's unfortunately having to become an even bigger part of our credit analysis because we're having to deal with those risks which we didn't have to deal 10 or 20 years ago. So.
Well, thank you very much. A great applause to you. Thank you for those very interesting insights. Do we have questions, dear audience? within the room? Well, I do have a couple of questions coming from people online. As discussed in the macroeconomic session, do you agree with Preqin, PDA and McKinsey that investor allocation to private debt will continue to grow from their 2021 levels? Who wants to take the question?
Maybe Wim, as you invest across.
Yeah, I think if I look at private debt, it has. We are now at around 22% of our balance sheet, and we come from around 11 5 years ago. So it's really doubled. Will it increase at this speed? Probably not, but will it increase? Yes. I think it makes perfectly sense, as I said, to take this illiquidity premium. Of course, this is a structural rise. I think you can have some more cyclical corrections on that. So it's possible that the speed is slowing down somewhat given the current market environments. But I'm convinced that after the market has corrected, that this will increase. Yes.
I'll add to that. I think yes. I think the answer to that is yes. I think the allocations will increase, probably to alternatives in general, so not just to private credit or private debt. And I think as investors start to understand alternative investments better, you will see far more allocation to alternatives generally, which does incorporate private debt.
Yeah, and it's been mentioned a couple of times on this panel, but I think one of the very attractive features of private debt in the current market is the floating rate nature of that market. So investors who want to sort of insulate themselves from potential further rises in government yields would find the market quite an attractive one to invest if that's their priority. But I guess in the very short term, it's a matter of potentially selling assets which have underperformed in other areas to invest in private debt. So I think the long-term trend is definitely there. The attractiveness in terms of illiquidity, complexity premium, in terms of structures, tighter structures, clearer exits, asset security that you often get on private debt, I think is all going to be very attractive to investors in the current environment.
One last question, very brief answers, please. What is your view on the actions of central banks? Will there be a recession or just a slowdown in economic growth? Who wants to take that question?
Any economists on on the panel?
I'm going to say nobody knows. Huh? Let's be honest. This is uncharted territory, and the way you have to manage this is think in scenarios. Huh? So we have to be sure that our portfolio resists to recession. We have to be sure that our portfolio resists in inflation. And then there will be some economists that will explain us probably afterwards why it went like it went.
Yeah, maybe what this planet needs is an increase in interest rates and inflation. So if we cut consumption, maybe that's how we reduce our usage of fossil fuels and carbon emissions. So maybe a good dose of interest rate rise is exactly what we need.
Well, thank you very much. A great applause to you all.